the public equity markets early stage. Now, that is starting to change. The market is beginning to understand that these are going to be very big ideas. They've been neglected, especially in the multi-omics space, or you'd call it the genomic space, life sciences. Now many people understand. But in terms of, so I wanted to say we're not a core portfolio. Many people would consider us satellite. And so it is up to advisors or individuals, if they're DIYing, do-it-yourselfing, to determine how much exposure they want to.
Cathie Wood opens with a bold prediction. One of the most profound applications of AI in the coming years will come from multi-omics, the integration of genomic, transcriptomic, proteomic, and other biological data. This revolution is largely misunderstood and underappreciated, but it's already beginning to show traction. ARK's Genomic Revolution ETF, once returning in the low double digits, has now begun to show upward momentum. Why?
One of them, now, to be sure, I've been saying this for a while, and this rubber band has been stretching for a long time. But I think the multi-omics revolution is going to be the most profound application of AI during the next few years. And having, I think that pure play portfolio, the Genomic Revolution portfolio, I think it is up to 6% compound annual rate of return, but it was very low double digits for the last few years. And now it is starting to catch a bid. And I think part of the reason for that is deregulation in two ways. First of all, we have a new head of the FTC who is much more open to M&A. And we now have strategic price discovery once again in this market. And you're seeing a lot of pharma and biotech companies buying into this space. Why? Because they have collectively a $300 billion revenue hole to fill during the next 5 years because of patent expirations. Our companies are going to help them do that, either partnering with them or they're going to be acquired. We don't want our companies to be acquired, but we are very happy to have strategic price discovery as other companies are required. So I think that is the most undervalued, underappreciated, misunderstood AI application in the world today. The second is really autonomous mobility. Tesla finally launched its RoboTaxi in Austin in June, and it is moving very quickly now into many cities and is expanding its footprint in those cities well beyond where Waymo's is. So we think most analysts have not adequately, shall I say, incorporated the robotaxi opportunity. It's really the autonomous taxi network opportunity for Tesla into their models. And as they do deeper research, they will learn that by 2030, the robotaxi or autonomous taxi network will represent 90% of Tesla's valuation in 2030. We're in print saying 2,600, but that does not even include the humanoid robot opportunity. Now, why am I focusing just on Tesla? Because it is the company that got it so early that there are 3 of our major innovation platforms converging. Robotics, autonomous vehicles are robots. Energy storage, they will be electric. AI, they will be powered by AI. So that convergence is going to drive a model which until now has been one and done. You buy a car, or you make a sale of a car and you hope they come back in 4 or 5 years. Very low gross margin, 16%. That will evolve into a subscription SaaS-like model in the robotaxi world. So recurring revenue at much higher margins. SaaS margins are in the 80s. And then beyond that, the same three platforms are converging to create the humanoid robot opportunity. And we think Tesla's in the pole position there as well. When many people ask about risk management, they sometimes think that ARK's portfolios are sort of generalist, broad-based exposures. And I would tell you they are if you're thinking about 5 years from now. But today, they represent a small slice of the market. Actually, we are the closest you'll find to a venture capital fund in the public equity markets. Now, we did start a venture fund, and that's now 3 years old and doing very well. But we think the real inefficiencies have been in the public equity markets early stage. Now, that is starting to change. The market is beginning to understand that these are going to be very big ideas. They've been neglected, especially in the multi-omics space, or you'd call it the genomic space, life sciences. Now many people understand. But in terms of, so I wanted to say we're not a core portfolio. Many people would consider us satellite. And so it is up to advisors or individuals if they're DIYing, do-it-yourselfing, to determine how much exposure they want to us. That's really an individual decision based on risk tolerance. That said, we have, while many people know us for our top-down research on robotics, energy storage, AI, blockchain technology, and multi-omics sequencing. So we are sizing markets using Wright's law to measure cost declines and so forth. The bottom-up stock picking and research and picking part of the process is as robust. That is my heritage. I came from a world that's the way we did things. So we have a 6-metric system to analyze both the opportunity and risk associated with each stock. The 4 of them are scored. They are people, management, and culture. So we watch management teams like a hawk. Are they strong enough to stand up to short-term oriented shareholders so that they can forego short-term profitability and invest? Moat, barriers to entry, often technologies, patents, speed at which technology is moving. Execution, for us, okay, how much are they spending in R&D as a percent of revenue? More important, where are they spending it? Are they spending enough, and where are they spending it? And are they building a management team to execute and scale the strategy? Product and service leadership, that's all about market share, which is not just stats from different services, but sentiment on social media. We get that all the time because we give our research away over social media.
Cathie also reflects on personal lessons from her early days in emerging markets. In the 1990s, she made large bets on Mexico, only to watch the peso collapse due to forces beyond the country's control. Even sovereign nations can't escape global forces. This lesson echoes in today's market, especially in the post-COVID era where performance has been concentrated in a handful of mega-cap tech stocks, the so-called Mag 6. While ARK stayed true to its innovation-first
the last 2 metrics, one is thesis risk. What could throw our investment thesis off? And that can be regulation. It can be new technologies coming down the pipeline that are going to disrupt our technology. So very focused on that and have always been focused on private markets. The last one I think is the most surprising to people. It's valuation. Many people think that we will pay anything for a very interesting company. That is simply not true. And so let me describe valuation. Typically, our stocks are selling at a premium valuation to the market. Again, why? Foregoing short-term profitability, investing aggressively. Our working assumption is that that premium compresses during the next 5 years towards a market multiple, if not a market multiple, very close. And our analysts and portfolio teams have to believe that the revenue growth and margin expansion associated with these companies is going to overwhelm the valuation compression and deliver a minimum 15% compound annual rate of return over time. This was the mid-90s, and I had been the analyst and the portfolio manager on most of our international holdings. Jennison was primarily U.S., but could hold up to 15% international. So we had moved into Mexico in a big way. Mexico was opening up from a financial market point of view. And Telmex, Televisa, we had a big exposure. 10% was a big exposure at the time. We got to know a lot of the CEOs, management teams very well. They introduced us to policymakers. And both groups said, Mexico will never devalue. And we bought into it. We thought we were wired into the system there. But you can't fight a global force. And Mexico devalued around Christmas time, absolutely shattering to me, because it meant that Jennison that year moved from outperforming the market to underperforming, which, of course, I took very personally. And so that was, for me, a big lesson. Do not think that a country controls its own destiny. If, certainly in the emerging markets, if there are global forces at work that will overwhelm it. So, but the most frustrating was, I would say, in the post-COVID years, 21, 22, 23 was a big rebound, but even 24, there was concentration towards the Mag 6, and we had a very difficult time. I think it was frustrating on the one hand, but it really, I think, cemented our brand in the marketplace, because we did not give up on these innovation platforms and our stocks. And we did not, for the most part, give in to conventional wisdom that, you have to be there with the Mag 6, Magnificent Six, or else you're being neglectful in terms of a strategy, even focused on innovation. And we were saying, those companies have been and are very successful, and some of them will participate in this new world, and some will be disrupted by it. And we want to expose our clients to pure plays in the new world, making the new world happen. So the frustrating, I guess my frustrations were that some of that psychology about Mag 6 and you're neglecting the innovation that these companies are going to bring to bear, that tried to permeate ARK. And so there was a bit of frustration there for a while that this was even happening, because it was taking us, it was distracting us somewhat from the amazing trends we saw evolving. And then there was one other frustrating moment, I'll say, and these are all very recent, but they were some of the most frustrating moments. NVIDIA, ChatGPT happened, boom, it takes off, but the rest of our stocks, they were mired and they were still moving down. So as we always do, we will take profits and rebalance effectively into some of the names that are underperforming, because we think truth will win out. Well, after we did that, and when we took NVIDIA out of flagship and moved into names more like Palantir, which was lagging badly, Coinbase, which was being sued by the SEC. The publicity we got for NVIDIA was, I couldn't believe it. And we had to defend ourselves saying, wait a minute, we're the ones who picked NVIDIA up at 40 cents on, maybe it's 20 cents on this stock in 2014, and we were pounding the table and nobody would listen to us. We were talking about autonomous mobility, robotics, AI. Nobody would listen to us, not until really the ChatGPT moment. They listened to us in a big way. It got a little crypto love in 2017 and 18 and then fell off after that. But that one, to have been so early, so right, and then get a headlines reading, and I usually don't pay attention to headlines, but how misinformed it was that we missed NVIDIA. We were all over it, and for years and years. And sure, did we miss that huge swoosh at the end? Yes, but we got it in Palantir, which is where we thought AI was moving. If NVIDIA was right, then others were going to have to be successful. And of course, Tesla was our biggest embodied AI play.
One of the most frustrating moments for ARK came when NVIDIA skyrocketed after the release of ChatGPT, and the media suggested ARK missed the trade. Cathie is quick to clarify. ARK was pounding the table on NVIDIA back in 2014 when the stock was 20 cents. They recognized its role in AI long before the mainstream did. But as NVIDIA ran hot, ARK did what it always does, rebalanced, took profits, and allocated into other AI names like Palantir and Coinbase, which were still underappreciated.